the downgrade to growth, and the increase in the unemployment rate, the fact that you saw an upward shift in the dots is kind of clearly a hawkish signal. At the same time, the fact that the Fed is telling you that they are cutting rates at median expectation 2 times this year, with core PC inflation that's 80 basis points above their target and growth that's essentially around potential, kind of continues to signal that there's a dovish bias there. So I think there's kind of clear elements of both of these here. I think the market's view is it's not as hawkish as was anticipated. I think there was a fear of a median of 1 rate cut for today, and so far at least that fear was alleviated.
Matt, you expected them to pause their quantitative tightening, this idea of allowing their balance sheet to shrink. Does this actually mean anything other than just a technical adjustment to smooth the gears of Wall Street?
No, I think for the Fed, this is clearly a technical decision. They slowed rather than paused. But again, I think that was kind of a technical decision about how they were going to deal with MBS and the fact that they might have to buy in the secondary market. And so really, this is just the Fed telling the market they're going to be very cautious in dealing with the balance sheet. They don't want to repeat the mistakes of September 2019. And they're going to be just cautious in dealing with how things evolve here.
I'm going to go to strategist John Farrow on this. You can't make this up. Out on Twitter, Ed, thank you so much for this, for John Farrow. My 16-year-old son has saved $500 and wants to invest it. Should he wait till after the press conference? What do you think?
That is the $1 trillion question. Matt Lazzetti, how do you think the chairman will approach this news conference in 8 minutes' time?
Look, I think he should just be repeating how he's been discussing the outlook, which is there's a lot of uncertainty at this point in time. They still think the economy and labor market are solid. They're in a wait-and-see approach here, and they're in no hurry to adjust rates. And I think by the May meeting, by the June meeting, they're going to have greater clarity on how some of these policies are working out. They're also going to have greater clarity on the fallout from the big spike in uncertainty that we've had over the past month. So by May or June, I think we should be hopefully in a reduced uncertainty environment with greater clarity about what the policy outlook is.
Matt Lazzetti of Deutsche Bank. Matt, one of the best. Appreciate it, sir. That news conference is about 7 or 8 minutes away. Whatever you think about the decision, you've got to reflect how the market is responding to it.
Ok, so aquí estamos de vuelta. La Reserva Federal no cambió los intereses, ya se esperaba prácticamente. Aquí ya nos estaban indicando que había un 99% de que no iban a hacer ningún cambio. So, ahora hay que esperar a creo que es mayo. The next Fomc meeting, 2 meses. Creo que es para mayo, febrero, marzo, abril o abril. El mercado reaccionó súper positivo al principio. So, esta es la gráfica de 1 minuto. Volvió a bajar y bueno, nada, hasta ahora todo positivo. Ahora en 5 minutos empieza a hablar Jay Powell. Y entonces aquí es donde vienen a hacerle las preguntas acerca de qué piensa de la economía, tararín, tararán. Y aquí es donde se puede complicar la cosa.
I think everyone's relieved that the Fed didn't jump to significant conclusions, that you're not seeing zero.
Por supuesto, no importa lo que suceda, sea bueno o malo, las noticias siempre te van a decir lo malo, te van a tratar de virar siempre todo, dirigir todo a lo negativo mejor. Lo negativo es lo que vende.
And who knows what's going to happen over the next couple months.
Is Fed policy still in a good place?
It's in a great place. It really is. I think it's a miracle. They got us to 4% unemployment, 4% wage growth, 2-ish% GDP, 2.5% inflation from where they were, and now they've been dealt a real problem with the global trade war, which is a stagflationary economy killer.
So I'm going to ask the question slightly differently then, but it's the same one. Is the Federal Reserve in a good place? For any central banker facing downside risk to growth and upside risk to inflation, it's not a good place, is it?
No, I told you, mark your calendar for 2031. That's when the tape of this meeting will be released. It's fascinating. The tension in the room must have been through the roof.
Lisa, regime change. Totally different place for this Federal Reserve to be in compared to where they before. And I remember earlier this week you talked about the contrast between now and the pandemic. And you made the point that in the pandemic, it was easier for the Federal Reserve because they knew what to do. Just respond with lower rates and buy everything. This time around, it's difficult to know how to respond to these kind of shocks.
And frankly, there still is a lot of disagreement about whether some of these tariffs are disinflationary ultimately down the pike. Right now, they have to not overreact at a time where they are very worried about unemployment rates going up because they know how scarring that can be for an economy and the sort of long lags that can hold.
I would point out that whatever anybody's politics, at any time you pick up your cell phone and you look at names 6, 7, 8 newspapers, including Bloomberg News, people are shocked, John, at the cacophony of headlines. I think the Fed is part of that discussion. They have to be incredibly ex post until they see those headlines work out, political headlines.
It's one of those meetings, Tom, where you can sort of create a narrative out of everything here, hawkish or dovish. I don't think it's material and something we haven't talked about just yet. If you look at the forecast for core PCE, yes, they had to revise that higher for this year, but I think it's notable. You really start to gauge how the Federal Reserve feels about if there is an inflation shock, how long lasting it will be. Now, I don't expect them to use the T word later on in this news conference, but it's implied in the forecast. They're looking for 2.8% in 2025. Relative to the previous projection of 2.5. But then you look at 26 and 27, unchanged at 2.2% and 2.0%. We're trying to tease out what they really think about policy without them telling us what they really think about policy. And I think that's one way of doing it.
So let's translate this. What this means is that there's initial adjustment up in prices with the tariffs, with some of the other trade tensions, with slower growth coming down the pike that limits demand because the supply is not going to be somewhat constrained or more expensive. And then you get disinflation because they have to ultimately lower their prices. This is what they're trying to gauge out. What their role in this is a lot less clear.
Is that another way of saying transitory in those forecasts, Bob?
John, you know what's amazing? We're 2 months into an administration that's creating this volatility. The Fed and we have 3 years and 10 more months of this to go. Think about that.
And we've still got to wait for April 2nd. The big changes come at the start of April.
So this is really something they have to deal with. How do they signal steady, calm, predictable hand at a time when everybody's heads are spinning and they cannot react too quickly? That is going to be a difficult thing to message given the fact that a lot of people are saying this has to do with policy changes that haven't been firmed up, that are still negotiations more than just pure policy.
We're beyond the world where you can provide forward guidance. So we're not expecting sort of clear clarity on any forward guidance, but this is the kind of world where you need to clearly establish the reaction function. How will you as a committee respond to certain scenarios? That's what we want to hear in this news conference, I think, and that's what we want to see from the chairman when that news conference begins in about 60 seconds' time.
And what you're going to get is some people thought this, some people thought this. Chris Waller dissented because he might be or might not be in the running to be Fed chair. This is going to be a very difficult messaging act for Fed Chair Jay Powell, especially given the flipping and the flopping from December to January.
Governor Waller can speak for himself. I'm sure he's got other ambitions that maybe Chairman Powell doesn't.
Ok, un minuto, vamos a ver.
Conference. Bob, you're always fantastic about this. What would you ask the chairman in this news conference if you had a seat in that room right now? What would be top of mind?
I'd ask him what the Fed is watching to gauge inflation expectations.
What do you think they are watching? Data? Or is it the survey data? Have they been spooked by that? Is it the hard data? Is it both?
I think it's a combination of both, and I think it's also going to do from their survey of small and mid-sized businesses, see what they're going to do with the price increases and see how much of those they'll push through.
How much weight they put on all of this will be incredibly important. The chairman of the Federal Reserve with a very challenging news conference. That news conference begins right now.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective.
Vamos subiendo bastante.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time, in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated, and of course these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also frankly a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully. Basically, every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys. But if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth?
When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low 2s in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at the They wrote down, meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy's in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature that has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing the people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment, because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected, and I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up, but prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly, and so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last
pandemic? Yes, during
okay,
the pandemic.
You could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that, and it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect that by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is from each of those two measures is from its goal. And then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecast that really shows significant problems like that.
Well, just to follow up, yesterday the UCLA Anderson forecast said there's a high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months, a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this: we don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels. Still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
Hi, thank you, Chris Ruge.
Nos vamos para la luna con Elon Musk.
As you know, I guess last night President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I no desire to change that answer, and I have nothing new for you on that today.
Well, maybe I have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or you just that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, that Michigan, the one you're referring to, the longer term thing, we look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that was kind of an outlier, but nonetheless we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the time frames and all that. We will use our tools to foster achievement of our goals to the best we can. And of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know in a couple of months. We'll know whether those were where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs, and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which by the way has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices, it's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental factor.
¿Cómo estamos, Gonzalo? Yo también estaba durmiendo y bueno, me levanté un poco tarde, pero sí. Prácticamente las noticias fueron que no movieron los intereses, todo está como que neutral, ni arriba ni abajo. Y bueno, hasta ahora todas las preguntas que le han hecho acerca de recesión, de el trabajo, la economía, hasta ahora todo. Y bueno, aquí vemos, vamos para la luna con Elon Musk.
So I think I'm into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth, but higher inflation. And they kind of balance each other out. So you think...
Ahora, estoy vigilando esto aquí porque desde el momento más bajo, lo más alto que hemos llegado fue 5.703 y ahí rechazó este nivel de aquí bien grande, tremendo rechazo que hizo ahí, y eso fue el día 17, hace 2 días atrás, y luego caímos de nuevo durísimo. Hemos recuperado y estamos casi ahí mismo. Ahora hay que ver si rechaza este nivel de nuevo de 5.700 o si lo rompemos y seguimos hacia arriba. En las recuperaciones, todo así, hay que ir rompiendo niveles, hay que convertir el piso en techo y prácticamente la resistencia, convertirla en soporte. Vamos a ver cómo nos va. Si no, todo ha subido.
Big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask, first of all, if you could clarify, you were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah, so in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not, but some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it, but as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whatever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really liked that. People thought that's a good idea. You know, it's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant.
Tell him, Charo, tell him.
We begin to see some
We're
of
going to the moon.
things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now.
Estamos
So you
ahí.
can see the underlying signal.
5,701, vamos.
And it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be
Profit ripping. Let's go, Charo, let's go.
Kind of a thing, and it had pretty broad appeal, I will say.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much. I mean, if at all. There's one reading that everyone's focusing on that is higher, but the other survey readings and the market-based readings all show relatively, well anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, what speed. There's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down. They tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer-term or medium-term inflation expectations are moving.
Chair Powell, Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy rate. I mean, they're all jobs, but and remember we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Here, a quick QT question. Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because we want to stop runoff in net at some point. We haven't made any decisions about that, but we want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in constant at some point, a point that we're not at yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunging confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside.
Wow.
So my question
Wow,
is,
arriba.
how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Matt.
Matt Eaton with CNN. Thank you, Chair Powell. The Fed statement released today removed the line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember, but we're past that. Or sorry, no, beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market, the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Wow.
Well, fortunately, we're in a situation where we have seen inflation move down from higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the twos, with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter. So I'm gonna pass on that one. Thank you.
Hi, Chair Powell. Daniel Avis from Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens? It will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell. Jean Young with M&I Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. Slows down the path and probably lengthens it, doubles it effectively by slowing it by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than it. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, pretty strong support. I'd just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, as I mentioned, well supported. Thanks very much.
He can't wait to get out of there. Chairman Powell, fascinating news conference, the most interesting news conference we've seen with the Fed chair in quite a while. Let's start with the price action. A big portion of uncertainty with a sprinkle of transitory. Equity markets rocketing. We're up by 1.5% on the S&P 500, on the Nasdaq up by 1.9, on the Russell up by close to 2. In the bond market, 2-year, 10-year, 30-year yields down and down hard at the front end of the curve by 5 basis points to 3.98. Check out the commodity market. Gold all-time highs. Intraday up by about 1/3 of 1%. There's a couple of interpretations here. Here's one. It's the bad news. So they've downgraded the outlook for growth, but haven't responded by projecting additional cuts. Here's the good news, and this is what the market seems to be leaning on just a little bit more. And the Fed chair spoke to it. Based on the forecast, the Fed believes that any upward revision to inflation in 2025 won't last beyond 2025, into 26, into 27. On that and more, take a listen to what the Fed chair had to say.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
A willingness to look through this, perhaps reinforced by this take on you, Mitch. Michigan inflation expectations reading is an outlier.
Okay, going back, there's a lot to unpack here. We can talk about Michigan and how much that actually did or did not inform the back in 2022 and why it's less relevant now. The point about transitory is a key one. This market is looking through the downward revision to growth of stagflationary-like circumstances that frankly defy logic for why that should be good for risk assets.
Bueno, lo interesante es que llegamos al mismo nivel de hace 2 días atrás y nada. Parece que vamos a caer nuevamente. Subimos bastante, lo cual es positivo, pero no hemos roto este nivel aquí, que viene siendo tremenda resistencia. 5.715. Y ahora una vela roja bien grande, bajando. Aquí lo vemos en el 5 minutos, ya se está desplomando un poco.
What's your reaction to all of the above?
Well, I thought the summary of economic projections was actually a bit hawkish in the sense that they downgraded growth and pushed up inflation, and the dot plots, plot did sort of shift up. They didn't shift up enough to change it from 2 to 1 rate cut this year, but it did shift up. Powell then came in and I think gave a pretty dovish performance in the sense that, we got this. We're in a good place. We can afford to wait. We'll see how it goes. We're going to get the job done. So he, I think, was pretty reassuring to people that this was all, quite manageable. I think the reality is, the growth outlook is worse, the inflation outlook is worse, and uncertainty is a lot higher. I'm not really sure how you parse that out as positive, but Powell put a pretty dovish spin on it.
Bill, that's where transitory comes in. It was resurrected, the word that was once left for dead, thought to look through some of the tariff-induced inflation, saying it probably would subside. What do you make of that? Because it's giving a lot of confidence to this market.
Well, one thing that he did talk about was inflation expectations, and he basically said, look, there's only one indicator that's really shown a significant increase in long-term inflation expectations. Everything else looks fine. So he's basically telling people you can ignore the University of Michigan long-term inflation expectations measure, which has shot up very sharply the last month or so. So that's reassuring. So I think people think Fed's got this. I think the reality is they're flying blind. They don't really know what's going to happen to growth. They don't know what's going to happen to inflation. And that increases the risk of making a policy mistake or just being late.
There was a book years ago, Bill Dudley, with a chapter by Bill Dudley and Ed McKelvey, and you said off of Patrick O'Brien, there's not a moment to lose. How ex post is this Fed? They're, to me, not a moment to lose. They are wait. Isn't that their best outcome?
Well, I don't fault them for waiting. I think when uncertainty is really high and and the economy is in a pretty good place. Inflation rates running 2.5%, 3%. The unemployment rate's around 4%. Staying here, indefinitely would not be a really bad outcome. So I think that's what gives them the ability to wait, because the starting point is actually pretty good. The other thing I thought was interesting about Powell's remarks is he sort of minimized the soft data that's showing a lot of weakness, and said we're really sort of focusing on the hard data. We haven't seen weakness in the hard data yet. So that was also reassuring.
This is what Marko Kolanovic formerly of JP Morgan, has to say out on X this afternoon. Not in a hurry means we will drag our feet when things get worse, like in the fall of 2018. This is not bullish at all. Bill, you've lived a lot of this in the past. Is there a risk of a repeat of 2018 here?
Well, I just think there's a risk that the Fed will be late because if you have to have the information in hand before you act, and there's long and variable lags of monetary policy, then you're not going to do the necessary action in a timely way. I think that the same, but at the same time, I mean, which way does the Fed lean? Do they lean against the inflation, or do they lean against the growth side? I thought it was interesting the summary of economic projections also didn't get a lot of attention, but people's assessment of uncertainty about inflation and employment both went up. Their assessment of risk to inflation and employment both went up, and I think that's really what tells you what's bad about the economic outlook now is that this dispersion of possible outcomes is pretty wide, and we just don't know which way we're heading.
Bill, you said that this is a Fed that's flying blind, and essentially Fed Chair Jay Powell said as much when he was asked why there was this ongoing 2 rate cuts priced into a market where you had some pretty sizable changes to growth and inflation. And he said, what would you write down? It's really hard to know how this is going to work out. Is there any time in history, Bill, that you can think of where the Fed was as flying blind as they are right now?
Well, I'm sure there have been other times. For example, when you had the 2 oil price shocks in the 1970s, that wasn't very good. You had the great financial crisis in 2007, 2008.
So, con todo eso que subimos hoy, desde el punto más bajo solamente subimos un 3.6%, prácticamente 200 puntos desde el punto más bajo, pero, o sea, nada wow, honestamente. Y al final sigue rechazando el nivel de 5.700. Ahí está 2 veces, o prácticamente 3 veces. Esto fue el día 17, el día 17, día 19. ¡Wow! Yo no puedo creer que vamos a bajar todo. ¿Dónde comenzó esto? Aquí a las 2 de la tarde. Sí, prácticamente a las 2 comenzamos aquí. 5.639. ¡Wow! No, yo creo que no vamos a tener que esperar mañana. Mañana eso que sube, hoy para abajo. Wow.
Market and frankly an economically driven market that the Fed can with in a constructive way.
Bueno, mira el dólar subiendo, stocks para abajo.
Information points. And Bill, I wonder what we've learned today. If we did get a deterioration in the economic data over the next several months, in the hard data, have we learned that this Fed would respond to that, or would this Fed wait? Because I think that's critical for a lot of investors. Are they constrained? Is the easing bias now constrained by the inflation uncertainty of the next 12 months?
It's definitely constrained to a degree. I think the thing to focus on is the unemployment rate. If the unemployment rate stays where it is, then the Fed can wait. If the unemployment rate goes up to, say, 4.5%, then the Fed has to worry about the whole thing giving way. So I think the tightness of the labor market, how the labor market is really important. And that itself has a lot of uncertainty. Because remember, the growth rate of the labor force this year is going to be much, much slower than it was in 2023 or 2024. Because very little in migration.
Este sub y baja viene bien para estas ETFs para que terminen pagando mejor. Sí, mientras esté así, en esos movimientos cortos, está bien. Lo que hace falta es que no haga el free falling ese de hace una semana atrás. Pero wow, de 715 a 677. Imagina tú. Lo que subimos en 30 minutos, bajamos casi la mitad en nada.
It's difficult to say with that in mind, Bill, that this Fed Reserve is in a good place. Do you think it's in a good place?
Well, they're in a good place in the sense that the economy, the starting point for the economy is in a good place. They're not in a good place in the sense that they're being hit with shocks that are bad for growth and bad for inflation. And they don't really know what the policy is going to be yet. So I think they're not in good shape in the sense of...
Bueno, ya son las 2:30 aquí donde yo vivo. Yo entro a trabajar a las 3 de la tarde. So, ya en 29 minutos me tengo que ir a trabajar. Tengo que bañarme, prepararme la comida. Así que bueno, me despido. Si algo, nos vemos mañana. Gracias a todos los que se conectaron. Vamos a ver qué pasa cuando cierre el mercado, qué señal hay. Bueno, también prácticamente ya comenzó el Power Hour, esta última hora. Ya el mercado cierra en 29 minutos. Y pueden ser cruciales esos 29 minutos. Puede ser que o que todo baje completamente, o que haya algún tipo de respeto de que suba algo. Vamos a ver. Pero bueno, nada, entonces nos vemos mañana. Pasen un buen día. Saludos y bendiciones a todos. Chao. Chao, chao.